Hello, guys, and welcome to this week's edition of the ITU Forex class, where we're going to be talking about trend trading. We're going to be talking about exactly what trend trading is for absolute beginners, okay? So if you haven't heard about trend trading in the past, or if this is your first time hearing about trend trading, then you're in for a ride because this class is going to help you to improve your trading by leaps and bounds beyond your wildest imaginations. Now, I have to make an admission to you here that actually I struggled. I really struggled with trading to become a profitable forex trader until I found out about trend trading. So this topic that we're going to be talking about today is actually near and dear to my heart because this was the first trading strategy or trading methodology that you could say that, which helped me to find profitability in trading. Okay, so one of the reasons why I absolutely love trend trading is that it makes it very easy for traders to become profitable traders, especially if you adopt the techniques, okay, of trend trading to help you become a profitable trader. So without wasting any more of your precious time, let's just dive right into it, okay? So first things first, what in the world is trend trading? Okay, so to keep things simple, trend trading is a method of trading which involves you getting into the market in the direction which it moves predominantly in. To help you understand this better, let's use the whiteboard for a minute, okay? So the idea is when you're trading any financial instrument, no matter how bullish it is, it's not going to move up in a straight line. And no matter how bearish it is, it's not going to move down in a straight line. What I mean by move down in a straight line is most times when you have a price chart, okay? Excuse me for a bit as I recalibrate my board here. Okay, so most times with price charts, what you would find out is that you have something that looks like this, okay? This being the y-axis, and okay, sorry, I think I clicked on something here. Okay, this being the y-axis, and this being the x-axis, okay? This being the x-axis. Let me quickly fix this a little bit. Okay, so we have something that looks like this. And, okay. Exactly. This being the y-axis, and this is the x-axis. Now, on the y-axis, what you're usually going to find is your price, okay? So the movement of price. This is what you're going to see on the y-axis. And on the x-axis is time, okay? Time. Now, what does this have to do with anything? When I told you about trend trading and I said that price doesn't move in a straight line, the idea is that when something is trending, or let's take the example of Bitcoin, when there was this mania for Bitcoin and, you know, the frenzy that we had for the past couple of years, you would assume that with the way people have been talking about Bitcoin and everything, that Bitcoin just shot straight up like this, okay? But actually, that's not true. That's not what happened to Bitcoin. Most times, not even Bitcoin, whatever trading instrument you're trading, if it's an uptrend, no matter how strong that uptrend is, you'd see that price would move up a bit, then it'll pull back. Then it'll move up higher than it did the previous time, and then it'll pull back a little bit again. Then it'll push up again higher than it did the previous time, and then it'll pull back. It'll keep doing this over and over again until the market cannot push up any further, and then it finds resistance. Okay, resistance, and it can't break above the price level that it did in the past, and then it reverses, and maybe that trend would reverse to the downside, or we would have a consolidation. Okay, so the idea behind trend trading is that traders would want to identify predominantly what is the direction that price is moving in. So if we are in an uptrend, that is over time, price is overall, it's moving up. Then traders know that the structure of an uptrending market is that it doesn't move in a straight line. It's going to move up a little, then it will pull back. Then it will move up higher than it did the previous time, then it will pull back. Then it will move up again higher than it did the previous time, and it will pull back. As long as this trend remains intact, price is going to keep doing this higher highs and higher lows and higher highs and higher lows indefinitely. So the idea is that there are lots of different ways to attack trend trading. I'm just giving you the basic concepts here, and then we're going to be talking about how you can use this knowledge or this edge that trend trading and market structure has in the market to build a trading strategy that would exploit this advantage. Okay, so some traders, when you're talking about trend trading, some traders like to trade what is known as the pullback. Okay, and some traders like to trade what is known as the breakout. Okay, so what is the pullback? A pullback is, like I told you, is when the market is trending, it's going to move up and then it will pull back a little bit, meaning it's going to retrace its steps a bit, but it's not going to go as low as the previous time that where the trend began. It's not going to go as low as this, because the idea is that if price for whatever reason moves from all the way up here to move way down, way below this level where it initially started this up bullish move from, then this is no longer a trend, because the assumption is in a normal trending market, price is supposed to be forming higher highs and higher lows. Okay, I made a mistake here. Let me quickly fix this here. Okay, it's supposed to be a higher low. So let's even name it from the beginning. So this is our origin point. So we are just going to call this our low. Okay, so let me do this. This is our origin point. Let's just call it our low. And then this was the first high. So this is the first low and this is the first high. Okay, at this point the trend hasn't even showed itself. Okay, this is for this example that I'm using. Okay, so the idea is that price moved from all the way down here, which is our first low, initial low, and then it moved all the way up here to this first high. But then now that the trend is beginning to form, when price pulled back, it couldn't form a low which is lower than this initial low that we had here. So by extension, this makes this a low, but it's higher than the previous low, and that's why you hear us saying higher lows. Okay, and then when price, after it does this pullback, it's now going to continue. It's like it's moving, it's running. Just imagine this. Let's say you are running a marathon or whatever, and for whatever reason, let's say you run a bit and then you rest for a little bit and then you pick up steam again and you rest a bit. You keep doing this. It's almost the same thing here with price, because price is going to advance in the direction of the trend and then it's going to pull back a little bit, take a little bit of breather. It's going to rest a bit before it gathers momentum again and continues pushing up in the direction of that trend. Okay, so this is the pullback. So remember, we said this is the initial position that price started. Okay, the move from, this is our low and this is our high. When you relate this low, this current low that's at the point when this was being formed, to the previous low, you know that this low is actually higher than the previous low. That's where it gets its name as the higher low. And then when price breaks above this resistance area to form a brand new high, this place here, this high is now going to become our higher high. Why? Because when you compare it to this previous high here, you see that this particular high is actually higher than this previous high. That's why it's called a higher high. So you hear traders, especially traders who use market structure or all those price action and everything, keep talking about price forming higher highs, higher lows, because again, after price makes this higher high and it pulls back, it's forming a higher low because this low is higher than the previous low. So if the market is truly, really in an uptrend, it's going to continue forming higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Okay, so this high is going to be higher than this high, and that's why it's called the higher high. While this low is going to be higher than this previous low here, and that's why it's called a higher low. Now, this is what the structure or the anatomy of an uptrending market looks like. This is what the structure looks like. And you remember I told you that different traders trade it differently. I, for one, told you that this is not like because I'm telling you this is the way that is perfect or this is the best way to trade it. No, this is just the way that I found works for me. I use breakouts when I'm trading in the direction of the trend. So basically what a breakout means is that when you identify the trend, you're going to actually wait for price to break above the previous resistance or a certain point on your price chart, and then when it breaks above it, the idea is that you are assuming that price is going to continue moving in the direction of that trend which is established, and so you are getting into the trade at the breakout point and hoping that your stop loss, which is below the most recent higher low, that is not going to be hit, because if price for whatever reason breaks above a resistance area and triggers your trade, but then out of the blue it comes all the way back down to hit your stop loss, which was below the lower high, then that trend is invalid. It has been invalidated, because if the trend is actually a real uptrend, price is supposed to be forming higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. It should not have any business to come all the way down to the higher low or even break below the higher low, because when that happens, then this trend is no longer forming a market structure of an uptrending market, which is higher highs, which is characterized by the formation of higher highs and higher lows. So I, for one, prefer trading with breakouts. That's when price breaks above a resistance level or whatever, then I get into a trade in the direction of the market's predominant trend. But some other traders, and there are hybrid traders also who trade breakouts and pullbacks, okay? Some other traders, instead of trading with the breakout technique, they prefer pullbacks. So when they identify that the market is in an uptrend, for example, they know that price is going to be forming, most likely to form higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. In this case, when price makes a pullback, they will be waiting for that pullback, and then when that pullback ends, when they start seeing signs that that pullback is going to end, okay, they see things like a long wick candle or a strong bullish engulfing, or all this type of things like that is showing them signals that price cannot move down any further, then they're going to make a calculated, educated guess that price is likely not going to move any lower, and so they will enter into a buy trade into the market with a buy trade and place their stop loss below the most recent higher low, because the idea is that if price is truly going to continue moving in the uptrend, or the trend is really still present in the market, price has no business coming all the way back down, okay, to go below this higher low. So they will wait for the pullback to happen, and then when the pullback is showing signs of ending, then they will enter into the market with a long trade, and depending on what they are risking and what their risk to reward ratio is, they will be risking, following the recommendations, risking something like 1% of your trading account's capital on a trade and aiming for maybe 2 or 3 times what that amount is. Again, remember from the previous classes that we talked about, you need to find what suits you. I can't just tell you that, okay, this is the market structure strategy for trend trading that I use, and then just go and trade with a 1:5 risk to reward ratio. If I tell you this, and you know what I told you about risk to reward ratios, the higher you aim for, if you're risking 100 pips every time and you're aiming to make 5 times what you're risking, that would be 500 pips. Does the market, especially for something like the Euro USD currency pair, which is not as volatile as currency pairs like the GBP, JPY or whatnot. Now, does this mean that if you're trading with the Euro USD and you go for a 1:5 risk to reward ratio, that price is going to be making 500 pips moves anyhow? No, it doesn't, because it's going to be much easier for price to hit your 100 pips stop loss than it will be for it to hit your 500 pips profit target. So in this case, you're going to have a low win rate. But that low win rate will be overcompensated for with that high risk to reward ratio that you have. But the problem is, if you are not a patient trader, or you are not a trader whose personality is can find it convenient to take a lot of losses in a row, that you're going to find it very difficult to stick to that strategy and stick to the plan, doing proper risk management and whatnot. So I can't just tell you risk 1% and go for 5%. You need to, evaluate your personality. Am I a trader who doesn't mind taking lots of losses in a row as long as my profits will be there and they will be good? Good. If that's me, then you could not only go for 1:5, but 1:10 also. But then if you're somebody who knows that, if you have like 2 or 3 losing trades in a row, it really starts to get to you, then maybe going for a 1:1.5 or 1:2 risk to reward ratio might be the answer. And after you've decided this, that's your risk management plan. You need to, again, backtest your trading strategy, prove that it has an edge over the markets before you even think about, going out there to trade with it on a demo account. And then once you see that it really has an edge in the real market, you move on to live trading, okay? So now that we've talked about this on the whiteboard, let's go back to the charts. Let me quickly do this. Let's get off the whiteboard and let's see an example of this in action, okay? So what I have here is, let me quickly drop this. What I have here on my chart is the chart of the British pound against the Japanese yen currency pair. Now, I want to give you an example, and this is a very, very good example. I'm glad I even found this. Let me show you this example here, okay? So, this is what it is, okay? Let me pick this. Like I told you, remember I told you that when price is moving, okay, in one direction predominantly over a period of time, that is what is termed as a trend. It doesn't mean that price doesn't pull back a little bit or, retrace its steps. No, it just means that over time, like we have on this chart here, price started moving from all the way down here, and over time it went all the way up here. This move would have happened, over a couple of weeks or whatever, okay, because this is the 4-hour chart. Now, if you take a close look at this area that I'm showing you on the charts now, you notice that price started moving from all the way down here. Ignore this this part of the chart, okay? Because this was a downtrend before price reversed. And like I told you, once we cover these things, you'd start seeing them on your charts much more frequently, because maybe your awareness hasn't been, centered towards them. That's why you haven't been seeing it. But once we've done this, it's going to become very easy for you to spot. Okay, so what we have here on the charts is, you can see that price was in an uptrend here. Okay, it was moving up high, then it will pull back a little bit, then it will move up higher again, then it will pull back a little bit, then it will move up higher again, pull back a little bit, move up higher again. So what does this look like? You see, this is the anatomy of an uptrending market, because I told you, in an uptrending market, let's say this was our low, and this was our high, okay? This was our high. You can see that price then moved to now forming this low is actually higher than the initial low, this beginning low that we have. And that's why this is called our higher low, HL. Well, when price broke above this resistance area here, it broke above it and then it formed a high here. Now, when you compare this high that price formed here, to this previous high, you'd see that it's actually higher than this high, okay? So this will be called our higher high. Again, you can see that this is exactly what we had. Price formed another low again, which is our higher low, because it's higher than this low. And when price broke above this resistance area, it formed another high, which is higher than this previous high. Again, price, when it pulled back and retraced its steps, okay, it formed another higher low. Until again, price moved up, broke above this resistance, and it formed a higher high. Okay, so like I told you, if the trend is really in the market, price is going to continue forming this higher highs and higher lows and higher highs and higher lows. But like I keep telling you, this doesn't happen forever. There's always, there's this saying in trading, okay, that the trend is your friend until the bend at the end. Okay, so this is exactly what happened, because price kept forming these high highs and higher lows, high highs and higher lows. But then look closely, you can see that again, because it takes momentum and a lot of money to form these moves that break above resistance and keep moving up and whatever. You can see that when price when price came here trying to break above this previous resistance here, there was not enough momentum in the markets. Okay, remember support and resistance that we talked about last couple of weeks, sorry. You can see that price found it difficult to break above this area, and now this area is acting as resistance. And because we know that price is not going to continue moving in the direction of the trend forever, you can see that this was the high, and so price failed to break this to form a higher high. And so now we've gone from forming, let me quickly do this. We've gone from forming higher highs to now forming lower lows and lower highs, which is the market structure for a downtrending market. You can see because price broke below this area, below this higher low, okay? And then, let me label it because it's the higher low. It's higher than this low here. So price broke below it, and then it started forming lower lows and lower highs, lower lows and lower highs, which is the market structure of a downtrending market. So this is exactly what I'm telling you, okay? Now, I told you there are two ways to approach trading trending markets. You can use the breakout trading methodology, or you can use the pullback. Now, for somebody who is using the breakout trading methodology, you can see that when price originated this move from here and it pulled back, for the person who is using the breakout technique, he'll be waiting for price to break above this resistance area. Then he'll put his stop loss somewhere below here because this is the higher low. And the assumption is that if price is, for whatever reason, going to trigger this trade for him, then it has no business whatsoever to come all the way down to this higher low or go lower than this higher low, because if that happens, then the market is no longer in an uptrend, and we'll just gladly take our 1% loss and call it a day, because we're not going to be right 100% of the time. Remember, we did the risk management, and I told you that even if you're only right 40 to 45 or 50% of the time, if you're trading with a 1:2 risk to reward ratio, which is acceptable, you still end up being profitable after taking a large number of trades. Okay, so in this case, in this particular example, if I'm using the breakout trading technique, this is what it's going to look like I showed you on the chart. I would wait for price to break above this resistance. I'll place my stop loss below this higher low, and then I would aim for a simple 1:2. Okay, a simple 1:2 risk to reward ratio. And you can see that price would have easily hit my profit target. This is using the breakout technique because I waited for price to break above the resistance somewhere here. But what of somebody who is using the pullback trading technique? Okay, what of someone who is using the pullback trading technique? For the person who is using the pullback trading technique, it's going to look completely different, because for the person who is using the pullback trading technique, remember, this is the origin point where the move started. So we formed this high, and then we have a pullback here. Remember what I told you earlier on? I told you that when it looks like the pullback has ended, what are you going to see? You're going to see that price is struggling to break below the previous area. Okay, so here, or let me just use, this is still a valid example. Again, trading, there's nothing that is perfect. Okay, I'll show you this example and I'll show you the next one, and you see what I'm talking about, because the next one that I just saw now, it makes it glaringly easy to see. But let's just use this example, then I'll show you the next one. So again, when price came around here, you can see that price was forming big red candles. But then for whatever reason, when price came somewhere around here, the range of those red candles started becoming smaller and smaller and smaller. And we now even started forming, doji candlesticks and whatnot. And then out of nowhere, we had this strong bullish engulfing candlestick that completely obliterated the other candles that we had. So, if these candles were 5'7", for example, this candle, it came from nowhere and it was double their size. So this is telling you that there's a lot of momentum from the bulls. Now, if you're trading with the pullback technique, you know that the move started here, price went up, and then when it pulled back, and it was finding it difficult to keep forming these big-bodied red candlesticks that will continue moving down, and then this happened. This is your cue, using the pullback technique, to get into the market, and then your stop loss will be somewhere here. Aim for your 1:2 or 1:1.5 or 1:1 whatever you're using. Okay, now the other example that I told you illustrates this point much better is, just take a look at the chart. Price is originating from this area for this particular trend, then it moved up, and then it pulled back, and then it moved up again, and then it pulled back. Now this is the example that I wanted to show you, because this is the things that would show you the signs. So let me just move one step back so that you see what I'm saying. This price action that happened here is what's going to show you the signs that there's weakness in the market, in the pullback, and then price is likely to continue moving higher. Why do I say this? Well, I say this because, look, there was this strong red bearish engulfing candlestick showing us that there's a lot of momentum, price pushing to the downside. And don't forget that we are in an uptrending market. We know that in an uptrending market, price is likely to keep forming higher highs and higher lows, higher highs and higher lows. So when we saw this red engulfing candlestick, we would assume that since it's so strong like this, so huge, that price is going to continue forming big, strong red candlesticks, like something like what we had somewhere here. Okay, but then immediately after forming this one, the next candle was an indecision candlestick. It was like the bears just came from nowhere and they said they have this power to move the market, but then they couldn't back that up because they couldn't move price any lower. And then the bulls stepped in, and then all of a sudden, from the bears forming candlestick that had very big bodies, like this big red candlestick, they now went to forming candlestick that barely showed that they were even around in the market, to now forming candlesticks that had strong rejection, price rejection on the market. Okay, and then all of a sudden we had this candle that not only was price rejected, but it reversed and closed here to form a hammer candlestick, for example. So this would have been our cue that, we're in an uptrending market and we know that price is forming higher highs and higher lows, and then price tried to break below this area, but it couldn't break this area. It's struggling. And so you could have easily taken a trade here, placed your stop loss. If you want a really conservative stop loss, you can place it below the previous higher low. But if you place it here, let me show you exactly, let me show you this. If you place your stop loss here, which will be a conservative area for you to place the stop loss, the problem with that, it's not really a problem, it depends on your preferences, okay? If you place your stop loss here, if you entered into the trade here, when the pullback was, we saw that the signs of the pullback was, it's like it's almost over. If you place your stop loss somewhere here and you're going for a 1:2 risk to reward ratio, this would mean that you're risking a lot of pips, okay? And since you're risking a lot, if you're risking 200 pips, if you're trading with a 1:2 risk to reward ratio, that would mean that you would need like 400 pips to hit your profit target, okay? Which is more difficult. But on the flip side again, it's going to be more difficult for price to hit your stop loss. But then some traders like to go aggressive, okay? So they will risk much less pips. So maybe their stop loss would be somewhere here, but then they'll be going for much higher risk to reward ratios, like 1:3 or whatever. Okay, so they might enter into the trade somewhere here, and then they'll just place their stop loss just below this area that price is struggling to break, and then maybe go for a 1:3. Okay, so again, is a trade-off. It all depends on what you want. And I've only shown you examples of winning trades here. This is not because when you're trading with, the trend or whatever, you're not going to get losing trades. In fact, let me tell you something. I've been trading. I told you that I found profitability through trend trading. But my strategy doesn't even have a 50% win rate. It's 40-something. It's 43, if I'm not mistaken. Over the back test and the forward test and everything. On average, my strategy just has a 43% win rate. But it's still profitable because on average, the profits that I make from my winning trades are way bigger than the losses I incur on my losing trades. And that's why, at the end of the day, my profitable trades pay for the money that I lose from my losing trades and give me extra as profits, okay? So I don't want you to have the thought that, okay, when we're trading with this technique, you're never going to have losses. See, if we're not going to have losses, then why is risk management a thing? Because if you know 100% for sure that you're not going to have losses, why wouldn't you risk like $1 million on a single trade and then aim for a 1:30 risk reward ratio? Because that would be an easy $30 million for you to make. But because there's uncertainty in the markets, because we don't know what the markets will do, that's why we need to protect ourselves using risk management. Okay, so I hope this clears the air. I hope this makes things easy for you to understand, because trend trading, like I told you, can really make an impact in your trading overall, especially if you pair it with proper risk management and all of the things that you need to become a profitable trader, which is having the right psychology and all of that. Okay, and this brings us to the end of this week's edition of the ITU Forex class. But before we wrap up, like I always tell you guys, this portion of the class, this portion of the company where we teach you guys how to trade Forex and how to perfect your Forex trading skills or improve your Forex trading skills using manual trading techniques, it's only one portion of the company. We also have another portion of the company which is involved in helping you guys earn while you learn, okay? Using automated trading techniques. We've got bots ranging from the ITU, ABT, ITU, SBT, ITU, Goldmine, and Goldmine Pro. All of these bots are meant to help you to trade on your behalf while you're learning how to trade and help you to manage risk properly, help you make money, in essence, okay? So if you're interested, reach out to us on the socials and we'll be more than glad to help you set things up, get everything up and running and, making profits while you sleep, obviously, okay? Especially if you're using our low-risk settings, okay? You're not trying to make $1 million overnight with a $100 account, which sounds ridiculous. But trust me, there are lots of guys who try to do that. So if you're interested, reach out to us on the socials and we'll help you set it up and show you step by step how to set everything up from your bots to the EAs to your accounts and everything. If you're interested, don't forget, reach out to us. And once again, thank you for taking time out of your busy schedule to come to the class. I look forward to seeing you guys in next week's edition of the training. Once again, thank you and God bless you. Cheers.